Yeah. 2. Yeah. Aye. I'm jacking the beat, you calling the cops. The yapping is cheap, I call you the ops. The rapping is heating, it's all cause of pop. You get a leak for the ball, get a drop. Feel like I'm wrong when I double it back, cause I'm making it harder to catch that. But I covered the ticket, I call you to visit. You tipping and hit up the cash app. Baby girl, been around for it, yeah. In the old days, I was stuck in old ways. Never really trying to flip the old page. Young man tripping at an old age. Thinking I was flicking, had a low wage. Led the bro days, then a slow praise. Thinking it'd be different, it would gon' change. Then it really didn't, it's a cold game, yeah. Ay, all I really wanted was the money in the pocket. Got over money, but the money ain't a topic. Like Bill Doe and the money gotta stop it. Kid need food and the whip need juice. I'ma get these views when
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, babies? It's your partners Dale and Cliff back in the saddle again, y'all. We know we look better than you guys. If you can, man, we said every single time, take that damn picture for your mom and them guys. And y'all, welcome to Real Estate Live. We went a little bit early today because we fathers, we got kids, wives.
You ain't lying. You ain't lying.
So y'all, man, welcome to this thing, man. Let's just get into it, guys. Let's walk into this thing, man. Guys, Cliff, man, how was the week, man? Talk to the paper, man. What's going on with the week, man? How was the week?
Good week, busy, market's changing, a lot going on, man. So it was a good week. How'd yours go?
It was good, man. Having to change some different lending type of scenarios, man, because things, guys, have been changing on the fly like crazy. And this is the reasoning why me and Cliff wanted to kind of unpack what's going on with the market, because some stuff is going on, man, and it's getting kind of crazy, man. And so we're gonna dive into this thing, man. You know what we do every single time, guys. We always start off with our current market analysis, and we got to bring in, I think, one of the most trusted sources is Patrick McDavid and his team at Value 10. We're gonna dive into what's going on real quick, guys, with the residential and commercial market. Okay. So me and Cliff are going to look at this and we're going to respond to what they're talking about. All right, guys, let's dive into this real fast. Cliff, man, here we go. All right, guys, here we go.
Home prices in March posted biggest annual decline in 11 years. Biggest annual decline in 11 years. It fell 2.4% in March to an annual rate of 4.4 million, marking the 13th time in 14 months that sales have declined, according to National Association of Realtors. The March drop follows February's surprise rise of 13 3/4 from the previous month. The slowdown in the housing market is now affecting prices, which fell 0.9% year on year to median existing home price of $375,000. Folks, there's nothing in Florida, South Florida at $375,000. This is places like Toledo. But the housing market is slowing down due to a rise in mortgage rates, high home prices, and low inventory levels. Housing starts, which measure U.S. home building, fell 0.8% in March from February, according to the Commerce Department. The number of new listings in March fell 20% year over year, while the inventory of home sales is 1% higher than in February and up 5.4% year over year. The cooling housing market is caused by a cooling economy, the prospect of a recession within the year, the high inflation, which is being fueled by housing cost prices. Tom, while I'm reading this story, Powell is getting ready to potentially do something with the rates. What do you know about what he's going to do? Is he going to raise rates? We're hearing mixed stories from a lot of different people. What are you expecting to happen?
Well, if Kai will get the T-shirt up for sale, we have the
2028.
It says, "Fight inflation, save the cheerleader." It's up there somewhere, Kai. You got to get it into the storefront on valuetimate.com.
What else, Tom? Go ahead. Keep going.
So here's what's happening. Powell is coming up, I believe, in the next he's heading up the stairs right now because the Fed is meeting right now, and there's going to be announcements in the next 24 hours, and then also a jobs report by Friday, Cinco de Mayo, in which we're going to hear, I think, a 1/4 point increase. And then, but we're also going to hear him say that we believe we've turned the corner on things, and so there may not be further increases in June and in July, and maybe when we get toward the end of the year, probably November timeframe, maybe we can see the first rate decrease. So that is what interest rates are looking like right now, that maybe we're right there on the edge of it. Now, what does all this stuff mean on the home prices? Well, that means that interest rates are still high.
Yes.
People are reluctant to put their homes on the market. Right now, there's only 980,000 listings available in these United States. 980,000. That is the lowest it's been in years. And that's resulting in what it says is home sales have fallen to an average of 4.4 million a year. There's about 100 million sellable homes in America. So they're saying only about 4.4 million of those will trade hands. In a strong year, it's usually about 10 million trade hands, like 1 in 10. So what do we have right now? People that have put their houses on the market, the price is still high, and they're reluctant to drop it because no buyers are approaching, so there's no reason to drop it. No other houses are on the market. There's no competition on their block. There's no reason to drop the price. So low inventory gives consumers few choices, and prices aren't dropping. And even if they could afford it, the interest rates on the mortgages are too high, meaning very few transactions happen, and that's what they were talking about here is U.S. home sales fell. That's not home prices, folks. That's a number of transactions. So your friend who's a realtor, less work. Your friend who's a mortgage broker, less work. Working for a title company, anybody that's in real estate has got less work and having a tough time, but there's no recession here.
No, they changed the definition in real.
Cliff, man, let's dive into this real fast. I'm going to remove them. Let's dive into this real fast. Have people out. This is on the commercial as well as on the residential side, man. What are your first thoughts from an appraiser standpoint, man, for the information that they're talking about?
Yeah, I think it makes a lot of sense. So right now, what I'm seeing, is the days on market are getting long. We're starting to see, especially we're in DFW, so 30 days on market's a long time out here. I'm starting to see it creep to 60. It's starting to go more. So the days on market, it's just going extended. So basically what's happening in the marketplace is people don't want to put their house on the market. If they do, there's no competition, so they're just waiting. They're not looking to sell it quickly. So yeah, man, they right on.
Yeah, guys, on Instagram, guys, sorry for some other reason it keeps pausing on and on again. What I can do is we can re-air it, guys, again, because I want to make sure that is fluid. It just keeps pausing. I'm sorry, guys. It's glitching, and it's not us. It's really Instagram's a system. But no worries, we will re-air it after this as well. So I'm gonna go ahead and end it on Instagram, guys. I'm gonna re-air it. I don't know what's going on, but it's what it is. All right. So concerning what's going on for me, I agree. And they're talking about in Florida. Florida is considered to be one of the hotbeds, right?
Yeah, especially Miami.
Yeah. And Miami, it's really bad. So, because I actually own a house in Florida, as you guys know, and it's slow pickings out there. And the same thing in Texas is the exact same thing. Now, that's on the residential side, and they were talking about rates going up, and we'll see it. We'll actually see a video a little bit as well, also on the Fed rate as well, because we're talking about all things economy. But at the exact same time, here is on the commercial side, Cliff. It's really bad there, man. You agree or disagree?
Yeah, you got to ask yourself a question. How many people are going into the office? About half as many. So it's down about 50%. So if you own an office building, and some of them ones downtown, those are $50 million, $100 million type locations.
Wow.
So it's losing half the value. They're gonna give it to the bank.
And also, you hear a lot of people in New York, they're talking about converting office buildings over to condominiums. And that didn't make any sense at all, because if you have 100+ units in a commercial building, you got to create 100+ bathrooms. The piping on there is it's not even set up for that. That is nobody's going to do that at all. So they're thinking like this outside of the box. Was it to make any sense at all? Now, going back to the residential side, guys, are the rates going to continue to go up, Cliff? In your example, Doc, from your peer view?
Nah, I think they're done. I've been calling for cuts second half of the year.
Really?
So
you think they're done?
yeah, so I thought they paused a little bit earlier than they did. They went about 50 basis points higher than I thought they would go. And that's just 0.5%, right? So I thought they'd stop at about 4.5%. They've gone up to 5%. But I think by the end of the year, you could see cuts, because the way the market's going right now, I don't think it'll survive it. I don't think the banks are going to survive it. I don't think the commercial real estate market is going to survive it. You got to realize, right? 50% value drop, and then multiply that by every big city in America. And on top of that, they can't even if they could make the payments, maybe they can make the payments with 50%, maybe. But when the debt rolls over, they're all at 2%, and they're going to have to roll it over at 5-6%. You can't. It can't survive. We got banks going down. I think they have to cut.
That sounds a lot like the bond market, because you had those banks you talked about going down, buying bonds and treasury bills at 1-2%, while the Fed chairman said they were going to raise the rates. These fools didn't listen, and they bought 10-year bonds, which was the dumbest thing in the world. Then what happened is the Fed, as he said he was going to do, raised the rates. And what happened then, guys? What happened then? Now all of a sudden, on the assets of treasury bills or T-bills and bonds, now you have banks own assets underwater. So they had to do a fire sale. And when there's a fire sale with a bank, what actually happens? People want a deal. Just like in real estate, they want a deal. If you have to sell, they're not going to pay retail. Would you? Hell, I would. I want a deal. I'm talking about a nice discount, 20-30%. So a lot of these banks have to do that as well. Now, let's dive into it a little bit, because Cliff talked about the rates, right? We got another video, guys. Against the state of the real estate market, another video. Let's dive into another video by Patrick and his team concerning the rates, because the Fed raised the rates again. Here we go.
Tom, what is going on with the economy? I know yesterday Powell said he increased the rates by 1/4 basis point.
Yeah.
What do you know about what's going on right now?
Well, we have an economist in the house, so maybe we talk about the economy and talk about the Fed yesterday. Well, as we like to say on this program, Jerome Powell did what he said he was going to do. He head upstairs and saw the cheerleader and pounded the economy for another 1/4 point. However, in his comments, the comments that Jerome Powell made, everyone was expecting him to have everybody reads the statements of the Fed, and we were looking for a moderated statement. And after this, I anticipate maybe a flat summer. And he starts talking about manufacturing in mid-year. Instead, he said, I got to watch this economy because, like training a dog, there may be more firming necessary. And when he said the word more firming necessary in his comments, Wall Street got nervous, and you saw the whole banking sector yesterday. It wasn't just First Republic contagion. It was concern that he used more firming may be necessary, which means in June, they think rates may go up. So what's going on right now? The most likely scenario, and I'm gonna go out and say this. So this is what I think, PBD. Everything I've looked at, I don't think we're going to see a rate increase in June. I don't think we're going to see it in July, because it's every 6 weeks, folks, that the Fed gets together with their board of governors and they all meet. And I don't think there's going to be a rate increase. Then we get all the way down deep into September. But what I do think is we are, and 88% of the analysts on Wall Street believe we're going to have a mild recession that is evident in the November timeframe. That will push the Fed's hand, and I believe in December you'll get your quarter point drop because they'll want to put liquidity into the economy because combination of unemployment and a defined recession, and unemployment usually goes with recession because people are not employed, not buying stuff, which pulls back GDP. I think that's what's going on. I think we're about to have a flat summer, but we did not get the enthusiasm about tamed inflation that we thought we were going to get from Jay Powell. And he put the next quarter point on there, and it's not going to help the housing market. It's not going to help mortgages, and it's not going to help business liquidity. There's a big credit crunch right now, and commercial real estate is in deep trouble.
So Cliff, man, what do you think about what he's talking about there, man? He it sounds like Tom's a good friend of mine. It sounds like Tom is agreeing with what you're saying.
Yeah, that's the way I see it too. I mean, he's been pretty accurate. I've been a little early on it. That's why I started buying stocks early. I got a little bit of I bought stocks a couple months ago when I thought I saw a bottom. And it started to pay off because once we know that they're going to stop, we know there's only up from here.
Yeah.
They can only cut. I don't think they're going to raise any more. We're tipping to where the interest rates are above inflation. That's where you need to be in order to curb it.
Yeah.
So now I think he's right. I think it's an opportunity. If you already missed it, last couple months, if you've been listening to me, I've been saying to buy. I've been saying to get in. Today, I made a stack today just on the stock market on the bump. So, I still think real estate in 6 months, the next 6 months, buy something, get in on something. It is going to be I think we're at a bottom. I think, Dale, what you think?
I normally don't disagree with Tom. Tom is a very smart private equity and venture capital guy, very seasoned guy. Cliff is very seasoned as well. I agree with you concerning the rates. They raised it up, and the Fed chairman did say he's going to have one more raise. And then the verbiage of what he said that then we're going to see what breaks. That is the portion I'm looking at. So they expected for something to tank. What it is, we don't know. And that could be a very dangerous type of reality for a lot of people that have actively invested in the market. Specifically, if you have a lot of these retirement funds, the 401ks, the IRAs, the Roth IRAs, the 403bs, the TSPs, those things, maybe even some annuities, depending on how they're structured, if it's a variable annuity or a fixed annuity. Here's my concern is what's going to break. I think there's going to be a lot of things that's going to break. And I think it's going to begin with the commercial real estate. Commercial real estate is going to break for real. Now, commercial, I'm talking about there's a lot of apartment complexes, class A, B, and C, that actually have not been receiving the full lease payments from their tenants. Half of them have not been paid, or maybe even a quarter, right? But they've been responsible for those mortgage payments. Or when half or 75% of your tenant base has been paying, there's probably not enough money to cover those payments, right? But there's maturity dates. A lot of these debts really on the apartments and commercial. What they've been able to do is they have these short-term finance, this bridge financing. It's what they got, not long-term financing. The maturity dates on the notes are going to come due. That's where me and Cliff are waiting on, because then that's when the deals come. Now on the residential side, the same reality is there, because me and Cliff were looking at numbers for residential real estate, and this is just in Jackson, Mississippi. Jackson, Mississippi is considered what I call a mid-tier town, which means there'll be a little bit correction on that, a little bit, because there's not a lot of inflation there. Cliff is actively, he and I are looking at buying some single-family residences in those areas. What we're seeing, guys, is there's been a 24% correction. Let me say it again for the folk in the back row. This is a mid-tier town, not a major metropolitan area like a Houston, Dallas, New York, or Miami. This is Jackson, Mississippi, right? A 24% decrease in value. That's crazy. So in other words, we look at the properties that they're worth $130, right? Now they're worth $100,000. Do the math. All you got to do is do $100,000 divided by 130. That gives you that arbitrage, the delta of the decrease. It was 24%. That's scary. That's really scary. So that means in those major areas, you're looking at north of 24%. Easy. Because a lot of the inflation was there. So when I hear the verbiage of what's going to break, that can be very scary to a lot of people. Cliff, what do you think, man, from an appraiser standpoint?
I think I gotta bring it back.
Okay.
I gotta bring it back. I gotta bring it back. Something you said months ago. You was right.
Mm-hmm.
He made a point, and I was kind of listening to him. I think I was a little right too. I knew we paused around here about it, but Dale was right, and Dale was right in the fact the government ain't gonna stop spending money.
They are not.
And so I don't think the rates we're at are going to bring down inflation to the 2% because there's too much extra money being spent on a monthly basis. And I underestimated how much money was coming into the system to keep the inflation rate high. So what may end up happening is something has to break. The Fed is going to either have to accept higher inflation, or the government's going to have to spend less money. If they don't, we are going to hold at this position for a long time.
Yep. Now, guys, let's dive into the bank failure side. We're looking at the entire economy, guys. All right, you guys trust us with your time. We're going to honor you guys with this time. We're going to look at this as well. This gentleman here does a great job in unpacking. It's going to be a very short video. We're not going to look at the entire video, guys. But man, let's look at the bank failure. Then we talk about where the economy is going after this, and then we end from that. Okay, here we go.
Crisis is getting even worse, and in coming days and weeks, even more banks could fail. With the New York Times reporting that small banks are rushing to reassure investors as shares plunge, with PacWest and Western Alliance being the latest casualties.
Those two are new. Those happened this week.
Yep.
Yesterday. PacWest and the other one. Let's keep going.
Talk about the risks to you of these bank failures. Number one, biggest risk is that if you have your money with a bank that fails, you could lose your money if you have deposits over the FDIC insurance limit of $250,000, which is why lots of wealthier people are frantically pulling their money from some of these over-levered regional banks. Watch out for these over-levered banks where their loans as a percentage of deposits are really, really high and elevated. You can see First Republic was number one,
wow.
Western Alliance number two, PacWest number three, with some of these other over-levered banks potentially running into issues as well. Because when a bank is over-levered and then their deposits drop by even more, they don't have.
Let's go back real fast. I want y'all to look at these banks. Look, First Republic, Western Alliance, PacWest Corp, First Horizon Bank, East West Bank, Ally Financial. Ally Financial is a big company when it comes to car loans. Key Corp, M&T Bank. Hello, Huntington Bank Shares, Zion Bank Corp, Truist Financial. Look at these banks. PNC, Fifth Third Bank, U.S. Bank Corp, Comerica Bank, Wells Fargo, Morgan Stanley, Bank of America, Citigroup, Goldman Sachs, Northern Trust, J.P. Morgan Chase. That is Frost Bank, BNY, Mellon, Stank Bank, Charles Schwab. Look at these banks. Now, you see up to Bank of America, they're okay. Be honest with you. They're okay. But then when you get up to about Comerica Bank, it begins to turn a little red, right? A little red, and it goes up and up. Look at this. Look at this. These banks here are not major banks. They're not. Those are those mid-tier regional banks. These down here, these are the big boys. J.P. Morgan Chase, Frost Bank, BNY Mellon, a Bank of America, Citigroup, Charles Schwab. These are the big boys. Notice how blue they are. Notice how blue they are. I mean, Cliff, my question, man, is what are your thought process, man, concerning these bank failures, man?
Well, you can already see it. They're going in order, right? So we already know if the bank, it's to me, it's simple math. If they bought those low interest bonds, they're gonna go down
They are.
because the value of those bonds has gone down. Period. If they still own them, and so what's going to end up happening is what we've learned, what I've seen from SVB, First Republic, is when they say they're worried about their deposits leaving, what they're saying is they're worried about five maybe 10 key depositors, big businesses.
Yes.
That's who they're worried about. Somebody pouring billions.
Yes, millions. Yes, exactly.
And let me ask you, Dale. I'm gonna ask you a quick question. You got a bill. You got $1 billion at you.
Yeah.
Are you gonna leave it in
Hell no.
PacWest? Are you gonna leave
Hell
it?
no. I'm
So
taking my
what's
stuff
gonna
over Bank of America, Chase, the big boys.
Right. If I got $1 billion, why am I sitting? Even if I got 100 million, I'm not keeping it at them banks. I'm going to
Hell
JP
no.
Morgan.
I'm going over there to the big boys. And now, what's his name? Kevin O'Leary said in one of the videos, he said he believes that what Biden did when he actually decided to cover the deposits over $250,000, he's effectively nationalized the banks. How is that? Because people are there. These are organic runs on the bank, and they're taking that money and put them to the big boys, right? Which means it's crushing regional banks. It's crushing the small tier banks. So they shut down. So there's no need for no merger and acquisitions, M&As. The consumer's doing it for them. So now if you go from, I think it's roughly 4,000 total banks, I believe, in the U.S., and I may be wrong on those numbers, guys. 4,000 guys, 4,400. What happened to Cliff? There he is. Okay. If it's 4,400 or 4,400 banks in the U.S., guys, that goes down to 5, 10. It's centralized control all of a sudden. No M&As were needed. No bailouts were needed. The consumers did it for them.
I'm exactly that. The banks, man, when the FDIC said we are securing all deposits, that is nationalizing the banks.
Yes.
You think you're buying shares of JP Morgan and other banks? You are not. It's the same as the airlines. The airlines are government-owned entities. So is the banks. They cannot fail. This is what it is,
guys. It is what this is not a doom and gloom type of show, guys. Today we're giving you the reality of what's going on. Right. Remember, we always say insure, leverage, and protect. That's our 3 strategies. You can only insure if you know what's going on, if you know where you're at, your current situation. This is what's going on, guys. No spin here. This is what's going on. It is what it is. So, Cliff, man, where do you see the economy going?
I see the continuation of where we're at. We're going to continue to see real estate go down because people are waiting.
Yeah.
If everybody knows they're going to cut, I know, we talking to all these people out here. Hope y'all paying attention.
Yeah.
Y'all know. So everybody's going to just wait it out. That's all it is. We're just going to wait. And during that time, banks are going to continue to fail.
Yes.
You're going to continue to see the same problems we've been having until, like what Tom said, till it gets to a pain point. And then you're going to see, I think you're going to see some politicians start stepping up going, hey, this is an election year.
Yes, sir.
We can't be having, yeah.
It's coming, y'all. The spin is coming, y'all. It's coming, man. You see it when it comes to the debt ceiling negotiation. I mean, you just hear it. That's why it's vitally important, guys, for you to check, recheck, and then recheck. Because of the fact that in widen that circle and invite in some wise counsel. Now, Cliff did say this here. But before I go there, this is what I think the economy is going. I agree with Tom. third and fourth quarter and the first quarter of next year is going to be a bloodbath. I don't say that being facetious or trying to scare nobody, because when I hear the Fed chairman, whose job it is try to tame what's going on with inflation, saying we're going to raise the rate one more time and see what actually breaks, that's concerning to me. Breaks, right? Not what rebounds, what breaks. It's concerning to me, right? And so that's why we say joint venture partnerships, locating distressed properties, because there's going to be a plethora of them, a ton of them in that third or fourth quarter and first quarter. It's going to be, for those, some people it's going to be, for those that are not prepared, that lack management skills and negotiating skills, it's going to be a horrible third, fourth, and first quarter. For those that actually have good access to cash or a credit profile, it's going to be great. Now, here's another thing. I see the credit market tightening up in third, fourth quarter. Tightening up. You agree, Cliff?
You're 100%. Because of what I just talked about. If billionaires are pulling their money, then you ain't got money to lend. Because so how the banks work, just to break down right quick. When you put $1 in the bank creates $10.
That's correct.
Out of nothing. So when you look in your bank account, you think you see, I don't know, $1,000. That's not there. There's only $100 there. The number, when you sign them agreements, when you first get your checking account, this is all what it explains. Nobody reads that.
Yeah.
Ain't nobody reading that. So you just get a checking account that says sign this docs, you signing it.
Yep.
So like Dale said, it's when the billionaires leave, they're gonna pull their credit, and that's gonna happen all at once, where nobody can get. This is 2008. There was no credit in the system.
Man, I'm trying to tell y'all, and those that actually have credit right now, don't be surprised if the bank shuts your credit line down.
Yes.
Friend of mine back in 2008 had a line of credit of $2 billion with Wachovia. Overnight, it was shut down. Overnight, shut down. And so that's why, from a private equity standpoint, from a private raise standpoint, we're raising $100, $200, $300 million because we are waiting for that to actually happen. We expect for it to actually happen. If that makes some sense, guys. That makes sense. So again, it's not a doom and gloom thing. Go ahead, Cliff.
I'm not saying when there's a credit crunch, those that can have access to capital can buy everything.
That's why joint ventures, guys, are so pivotal, and knowing how to locate distressed properties. Because if we could partner with you guys in acquiring a distressed property with you or from you, who wins? Everybody. Everybody, guys. So we don't get on here, guys, selling this stuff, man, so that it tell you about this course so that we can make some money. No, this is to help your ass out. This is to help you out. We ready. We ready, Cliff. We ready. Are you guys ready? All right. Matter of fact, Cliff, but while this is going on, guys, we got a video for you guys real quickly, talking about this real quickly, man. And we'll be right back, guys. Here is the video. We want you guys to see what you get in this course. Again, this is for you guys. Here we go. Good, guys, it's your partner, and y'all, it is here, guys. You've asked for it, and your partners have delivered the real estate course on how to locate distressed properties in your town in today's economy. Now, what do you get in this course? Well, you get a day-to-day blueprint on how to locate the exact databases that actually have a list of these distressed properties. And we also include a bonus strategy as well, also to where you can actually get a list directly in your town by calling a certain number. All right, guys. Number two, once you locate these properties, you're going to have to understand how to market to gain the attention of the sellers of these properties so you can begin to negotiate. We give you an actual blueprint on how to get that accomplished. And number three, we also give you access to our cash flow analyzer. This is the exact spreadsheet that we use to vet every single multi-million-dollar transaction that we actually acquire, whether it be a single-family residence, a commercial property, or an apartment complex. And guys, you get all that for the cost of $97. That's the entire cost for the entire course. Just $97. Click on the link below, swipe up, or DM me. I'm ready. All right, guys. That is the course, guys. Real simple, what you actually get. For you to actually get the course, you get two things. If you're on Instagram, you click on the link in my bio, and you'll see that actual course right there. And if you're on all other platforms like LinkedIn, YouTube, Rumble, Facebook, just scan this QR code. Go right to it, guys. $97. Get access to it immediately. Again, we're doing this, guys, because we know what's coming. If you know how to locate distressed properties, be honest with you guys, you'll never be broke ever again, because money follows value. And Cliff, are we looking for this? Are we or other investors that have access to capital looking for distressed properties?
Oh yeah, all the time.
All the time. And will we buy them boys fast?
Oh yeah, yeah.
Will we also partner with you? If you want to partner with us in the deal, will we do that too as well, Cliff?
Yeah. Bringing the deal, and we break this down into the training, but it's pretty simple. I always think of it. I always try to get to the basic principles of what you need to do. It's two things in real estate: it's deals and dollars. That's it. Deals and dollars. So we got the dollars. Y'all need to bring the deals, and we teach y'all how to do that. So we're trying to create win-win situations.
Mm-hmm. That's it, guys. But guys, that's all we have for today, guys, man. Thank you so much for your time, guys. We sure appreciate you guys, man. You know how we say this all the time. Before you leave, and while you can, you see that thing, take that damn picture and give it to your mom now. Y'all have a good weekend and holler at your partners. All right, y'all. God bless you guys. Peace, guys.
God give thanks. Bless God, give thanks. Bless God, give thanks.